Good evening, my host. Good evening.
Good evening, Prof. We can hear clearly.
All right, thank you, ma'am. Good evening, everyone. Welcome to our class on this platform again this evening. Without wasting our time, we are going to start from where we stopped yesterday, which is adjusted present value. Yesterday, we started the topic, and so far so good. We were able to and how this component is computed. We look at all those ones yesterday, and I want to believe that we have created a time to go through those notes we gave yesterday. Now, today, without much thing to do in terms of explanation, I'll just give you the situation which will warrant the use of APV. I think that's the only thing which I have not given to you. Which situation? What should you be looking for in the question that will make you to conclude that, oh, in this question, I have to use APV. Or in this question, I have to use MPV. What should you be looking for in that question? Number one is that for you to use APV, the first thing is that the company is diversifying, okay? Company is diversifying. Take note of what I'm saying. When you go through a question, and in the question you discover that that company is moving to another industry. The company wants to undertake a project in an entirely new industry from where the company is currently operating from. It means business risk will change. Do you understand? It means business risk of the company will change if that project is undertaken. That is number one. Number two is if the company is going to issue additional capital, whether in the form of equity, in the form of debt, or a combination of the two, in order to finance that project, then that should be a factor that will make you to use APV. Let me now expatiate more on point number two that I just mentioned. If a company is going to borrow or is going to issue additional equity, or the company is going to issue the two in order to finance the project, it means that after undertaking that project, the company's journey is expected to change. If the current journey is 40-60, for instance, after taking additional capital, the journey is going to change. It means business risk, financial risk will be affected. That's what it means. It means if that project is undertaken, then that company's financial risk is going to be affected. Now, if, however, the question tells you that this question will borrow, or so this company will borrow, or the company will issue equity in order to finance the project, but the financial risk will not change. That is, journey will remain an APV question. The moment financial risk is not going to change, whether you borrow to finance the project, or you finance the project with equity, or a combination of the two, the moment it is not going to affect your journey, then you are not using APV for that. you are not using APV. My host, please, can you hear me clearly?
I hear you clearly, Prof.
All right. So if the network is breaking, it means it should be your own network. I will advise that you restart your device and join the class again. Okay, thank you. So if we are taking additional capital to finance the project and our gearing is not going to be affected, please, that is not APV question. We have to evaluate that project based on NPV criterion, okay? Evaluating it based on NPV criterion. It is only when financial risk will change that we are using APV. Okay, number 3 is when the question, you can see issue cost, maybe issue cost of equity or issue cost of debt. The moment there is issue cost in the question, then that might be what? APV question. Number 4, the moment you are seeing subsidized loan in the question, then it is APV. As you evaluate it using APV criteria. These are factors that what? That will prompt you to use APV to solve a question. However, out of these 4 factors that I've mentioned, only one is the most important. That if that one is not there, then all others are not sufficient for you to conclude that you are using APV. And what is that? The only factor, the only major factor which must be present before you can consider the use of APV is when the company is taking additional capital to finance that project and the financial risk is going to change as a result of that. That is the only, I call it the primary factor. All other factors are secondary. If you have the secondary factor and the primary factor is not there, please, you are not using APV criteria. I believe that is gotten. Now, yesterday, when we finished sorry about the network. Welcome back. No, I made mention of the fact we have some topics to cover, and of course, I mentioned it yesterday, but it is surprising that the feedback I was getting, I was not too happy with it because some people say I didn't address the issue, and of course, I remember vividly that I mentioned it at the end of the class that we are going to take after APV, that are going to business evaluation, after business evaluation, merger and acquisition, and that if time permits us, we are going to take portfolio theory, option pricing theory, then hedging. These were the topic I gave yesterday at the end of our discussion. So I've repeated it again. These are the topics I intend to take if time permits. If time permits. Okay, so let's go straight and solve the question on APV now. Let's go and solve a question on it. Let's go and solve a question on this. Question 1. Okay. Now, as usual, what will I do? I'll go and read the comment of this question before I read the body of the question itself. What is the requirement telling me to do? Required. Estimate the adjusted present value of the project resulting from the new investment and from the refinancing proposal, and justify the use of this technique. Okay, so let's see. We have to use APV and justify the use of APV. Now let us read the question. Let us read the question. Baron PSC is a listed company in the telecommunication business. You are a senior financial management advisor employed by the company to review its capital investment appraisal procedures and to provide advice on the acceptability of a significant new capital project. The data, you can see, significantly what? New project, which is the data. The project is a domestic project entailing immediate capital expenditure December 31st, 2018, and with projected revenue over 5 years as follows. Now, what is this saying here? The claim on the project is going to be what? 800 million, and the revenue is going to be as stated under. Let's look at the revenue. Revenue from 2009 to 2013, 690, 800, 1,100, 650 direct costs are 60% of revenue. Okay, so you can see our direct costs there, 60% of revenue. Beside that paragraph, if I were you, I would put DC to represent my direct costs. Okay. In the first 2 years of operations, acceptance of this project will mean that other work making a net contribution before indirect costs of 150 million for each of the first 2 years will not be able to proceed. What is this question telling us? The question is telling us that if we decide to continue with this project, we are going to discontinue some operations from where we are generating a contribution of 150 million naira. So that 150 million naira is regarded as an opportunity cost. Okay? We are going to lose what? This 150 million naira. This is what we call opportunity cost. Okay? That is the benefit we are going to forgo if we undertake the production of what? We undertake project data. So it is an opportunity cost in the first and second year of operation. Okay. The capital expenditure of 800 million is to be paid immediately. Okay. We are paying this amount immediately, that is year 0. And the equipment, we have a residual value after 5 years of operation of 40 million. That is the scrap value of the equipment at the end of the project. I believe you are noting this. Please take note of them. The company depreciates plant and equipment on a straight line basis. And in this case, the annual charge will be allocated to the project as indirect charges. Okay, what are you saying here? That is our depreciation. I was told that our depreciation should be treated as what? Indirect charges. It is an indirect cost, so, and its depreciation, it is an irrelevant cash flow because it is depreciation and it is what? Indirect cost. So let us continue. Indirect cost can be like your allocated head office charges, okay? Your head office charges allocated to the project can be regarded as your indirect cost. Okay. Excuse me, let me check. If you don't have audio, please join the audio from your device at the bottom left of your screen. You see join audio there. Okay. I want to believe my host can hear me clearly, right? So if my host can hear me, it means the problem should be from your own end. Join the audio from the bottom left of your screen. And if the problem persists, please restart your device. Thank you. The company depreciates plant and equipment on a straight line basis. Okay, I've taken that. Pre-construction design and contracting costs incurred over the previous 3 years, total 50 million, and will be charged to the project in the first year of operation. This 50 million is a pre-construction design. Is more or less a research and development cost, okay? It's more or less research and development cost. So it is regarded as a sunk cost because that cost has already been incurred prior to the commencement of the project. It is not going to be affected. It is not going to affect our what? Our project evaluation. Okay. The company pays tax at 35% on its taxable profit and can claim a 50% first year allowance on qualifying capital expenditure, followed by a written down allowance of 40% applied on a reducing balance basis. So this information is for capital allowance. We are told that our capital allowance is going to be 50% in the first year, and the subsequent year is going to be 40% on a reducing balance basis. Given the timing of the company's tax payment, tax credit and charge will be paid or received 12 months after the rise. So what does that mean? It simply means that our tax is paid a year in arrears. Tax is paid a year in arrears. That is information there. The company has sufficient other profit to absorb any capital allowance derived from this project. Working capital is expected to be 30 million in the first year of operation, and this will increase by 10% throughout the life of the project. Throughout the life of the project. Okay. Sorry. Throughout the life of the project. Next one. Okay. The company currently has 7,500 million of equity and 2,500 million of debt in issue. quoted at current market values. The current cost of its debt to quickly change my network. Sorry about the disconnection. So I've changed the network. I hope this one should be better than the one I was using before. So let us continue. So the current cost of its debt finance is NIBOR plus 180 basis points. NIBOR means Nigeria Interbank Offer Rate, which is the rate of borrowing within what? Among banks. Rate of borrowing among banks is the NIBOR. Now, for a company to borrow, for a corporate organization to borrow from the bank, you cannot borrow at NIBOR. NIBOR is like the risk-free rate. Do you understand? NIBOR is like the risk-free rate. Your corporate bond is risky, so you cannot borrow at risk-free rate. For you to borrow, there's going to be additional return to compensate for financial risk. That additional return needed to compensate for financial risk is what is measured by basis point. Now, what you need to do is to convert this basis point to percentage. How do you do that? To convert basis point to percentage, just divide by the basis point by 100. Just divide the basis point by 100. Okay? NIBOR is currently 5.4%. This is my NIBOR now. Look at my NIBOR. My NIBOR is currently 5.4%. It means that my cost of debt is NIBOR, which is 5.4%, plus 1.8, because 180 over 100 will give you 1.8. So my cost of debt is 5.4 plus 1.8. Do you understand? Okay. So NIBOR is currently 5.4%, which is 40 basis points above the 1-month Treasury bill rate. The market risk premium is 3.5%, and the company's beta is 1.4. The company's beta, don't forget, the company's beta is what? The company's beta. Which company are we referring to? Barron. Barron's beta is 1.4%. Let us continue. Banga, a company already operating in the industry as that of Project Daton, has a quoted beta of 2.4 and a debt equity plus debt ratio of 30% by market value. Now, don't forget, Project Dato is a diversification project. So it means in that industry, we need a proxy company. So Banga is representing a proxy company. I've explained that in detail yesterday. So I don't expect that we have much issue in that area. So Banga is representing our proxy company right here. Okay. And Banga is having what? Beta of 2.4, quoted beta of 2.4. Now you can see the coin says quoted beta. The coin did not tell me whether it is equity beta or asset beta. But look at the information. And debt equity plus debt ratio of 30%. It means that Banga is geared. The moment Banga is geared, that means the beta of Banga is also a geared beta. Do you understand? So that beta is a beta of equity. Baron wishes to raise the additional finance for this project by new bond issue. Can you see that? Now, this is the information I have in this question that make me know that I will use APV, because Baron want to finance this project by taking additional bond. The company want to issue bond in order to finance that project. So my financial risk will change. That is the only one thing that will make me to consider APV, not because the project is diversification. No. That one alone is not sufficient for you to use APV. Okay. It's advisor. Do not believe that this will alter the company's bond rating. That is, this 180 basis point is the bond rating. So it's not going to change. That's the information there. Each advisor do not believe that this will alter the company's bond rating. That is, the basis point attached to its bond is not going to change. Please, I will urge you, because we might not be able to take that topic. Read bond valuation. Read bond valuation. Okay, please make sure you find time to read bond valuation. Very, very important. The new issue will incur transaction cost of 2% of the issue value at the date of issue. That is our what? Issue cost. That is our issue cost. Our issue cost is 2%. Did you see? The question did not tell you gross finance required. You understand? Please take note. Assume that debt beta for both companies is 0.5, 0.7 rather. That is the debt beta. And that both companies pay tax at the same rate. So that is the information. Let's go straight and provide solution to this question. I don't want us to waste much time, because this is not different from our MPV. The only new thing we added to it is that finance effect cash flow that I discussed with you yesterday. Now, the first one is our normal MPV. What do? I need my revenue. I've been given the revenue right there. Abi. So you can see our revenue here. Simple. We are not told to inflate it. The question did not tell us to inflate the revenue. So I will just lift the revenue in the face of my solution without any adjustment. Okay, that is the revenue. Now, direct cost. We are told that the direct cost is 60% of revenue. 60% of 690 is what is giving me this. You can confirm it, please. Let me get my calculator. Let me confirm. Okay, let us confirm. Take your calculator also and confirm. 0.6 times 690. 414, which is correct. 800 times 0.6, that is 480. 100 times 0.6, that is 660. Then 650 times 0.6, that is 390. And 200 times 0.6, that is 720. Okay, so that those figures are perfectly correct. They are correct. Do you know the reason why I added new year 2014? It's because of tax. You know our tax is paid a year in arrears. So year in 2000, tax in 2013 is going to be paid in 2014. So I need to extend the project by additional 1 year. Do you understand now? Okay. Now, we are told that if we continue the project that on, there's going to be opportunity cost in year 1 and in year 2. So the opportunity cost is 150,000. These are the opportunity costs in year 1 and year 2. Opportunity cost will not exist after what? After year 2. That is why you cannot see any figure in year 3 to 4 or 3 to 5 rather. I believe that is clear. Let me see. Do you have any issue with the opportunity cost? If you do, please, let me see your question before I proceed. Do you have any issue with the opportunity cost? Any issue with the opportunity cost? Let me see now, so that when we go deep into the question, we know how to be going back and forth. Okay, Doris Azike, you said yes. What is the issue, please? Can you ask so that I can address it before we continue, please? What is the issue? What is the issue, please? We have a lot to cover, please. And don't forget, I've given you about 4 more topics that I intend to cover, if time permits. So, and we have, after from this, we have 2 weeks left. It is given in the question, ma. It is given in the question. We are told that if this project continue, there's a project for which we are currently generating 150,000. The project will not continue. Will not be able to continue the project. Therefore, that 150,000 will be lost. If that 150,000 is lost, what is causing the loss? Project data. So that loss in revenue is specific to project data. That is why we have to charge it to project data. Do you understand? Okay, let us continue. Now from there, we have our taxable profit. From there, we have our taxable profit. Okay. From there, we have our taxable profit. I believe all this one, they are not what I should waste time upon. Abi, we all agree with that now, Abi, that I know I need not to waste time on this. I have explained to you right now, Ahmed Muniru. I said, look, okay, let me go back to the question. Do you want the question to tell you specifically that this opportunity cost? No. It's not done that way. You have to see it by yourself and be able to interpret it. Look at it. In the first 2 years of operations, acceptance of this project, that is, if we accept project data, we mean that other work making a net contribution before indirect cost of first 2 years will not be able to what? To proceed. What does that mean? If we undertake project data then this project giving us 150 million naira as contribution will not be able to continue with it. If we do not continue with the project, are we not going to lose that 150 million? Of course, we are going to lose it. Now, what is causing that loss? Can you tell me what is causing the loss? What is causing the loss is the project that we undertake. If we do not undertake project data, then that revenue will come. But because we are undertaking project data, we are going to lose the revenue. So that 150 million, it is the opportunity cost of accepting project data. And opportunity cost is a relevant cash flow. Do you understand? Opportunity cost is a relevant cash flow. So the question will not tell you specifically that this is an opportunity cost. No, you have to interpret the question and know that it is an opportunity cost, okay? It is an opportunity cost. Doris Azuki, I'm going to find you 5,000 naira MTN recharge card after this lecture. You send it to me. You know what you did, Abby? Doris Azuki, you know what you did? 5,000 naira recharge card, MTN. After this class, I want to receive it. That's your fine for not muting your video. Yes. For not muting your video. You are using your hand to cover it. You have to mute it, not using your hand to cover it. Okay? Okay, let us continue. Please mute your video, please. Okay? Yeah. So you should be seeing my face. Okay, thank you, Mrs. Doris. Let us continue. I believe the concept of that opportunity cost is clear. I believe the concept is clear. Or do we still have any issue with it? Yes, that's it now. Forgone revenue. Mr. Ahmed, forgone is another name for opportunity cost. I can tell you it's an opportunity forgone. Okay? An opportunity forgone, setting as opportunity cost. That opportunity, we are forgoing it. Okay? We are forgoing it. So it is the same thing. You said no, sir. It's not clear, right? Mr. Ahmed, is it not clear? Please, let me know, please. We are running out of time, please. I want us to finish APV today, by God's grace. I want us to finish APV today. I can't see your response, so let me continue. Now, so that is that about the opportunity cost we have there in our solution. Okay, so this gives us our taxable profit. That gives us our taxable profit. And after getting our taxable profit, then we charge our tax at what? We're told that tax rate for the two companies is at 35%. So, and it's paid a year in arrears, don't forget. It's paid in a year in arrears. So 35% of this, let me confirm again. I learned, someone started me off that it's like there is a mistake on those figures. That's why I want to confirm it, okay? I want to confirm it. 126 times 0.35, that is 441, that's correct. So 170 times 0.35, that is a 59.5, correct? 260. Sorry, 440 times 0.35, that is 154, which is correct. So 260 times 0.35, which is what? 91, which is correct. And 480 times 0.35 is what? 168. So my taxes are what? Are correctly stated. There's assurance there. They are correctly stated. Okay. Now, after I have gotten my tax, I need to go and do my tax saved on capital allowance. Now I go back to the question. How am I asked to compute my capital allowance? The question says, the companies The company depreciate plant and equipment on a straight line basis, right? On a straight line basis. And in this case, the annual charge will be allocated to the project as indirect charge. Okay, no, that's not what I want to pick. Okay, this is the information I want to pick. The company pays tax at 35% on net taxable profit and can claim a 50%, I can claim a 50% first year allowance on qualified capital expenditure, followed by a written down allowance of 40% apply on a reducing balance basis. So our capital allowance is on plant and machinery, 50% in the first year, 40% in subsequent year on a reducing balance basis. So I need to go and compute my capital allowance, then I do my tax saved on capital allowance. That is my work note 1. I want to believe I include it here. Okay, good. This is it, M. This is our capital allowance. It starts from here. Now look at it. Year one, our capital allowance, this is the cost of the machine in year 1, Abi. And in year 1, we are going to charge 50% capital allowance, 50% of 400. I think that thing did not arrange very well. After the conversion, it seems scattered. So let me show you. 800,000 times 0.5 will give me 400,000, no doubt. I will now say that 400,000 times 0.35. So that is what is giving me that 140,000 as my word, tax saved on capital allowance, okay? That is what is giving the tax saved on capital allowance. I believe that is clear. Okay, now in year 2, the tax written down value is 400, right? Yes, that is the cost of the machine minus the first year capital allowance enjoyed. That will be 400. So I will say that 400 now times what? Times 0.4. Because after the second year, capital allowance will now be charged at what? At 40%. So I will now say times 0.35. That gives me 56,000. So that is my tax saved in year 2 on capital allowance. Now the tax written down value in year 3 is going to be 400 minus that 160. That will be 240. I will now say that 240 times 0.4, which is the rate of capital allowance. Then I multiply by the tax rate. Then I get 33,600. That's what I have there in. Now after that, I will get my written down value as 144. 144 times 0.4, then times 0.35. That gives me 2160. I believe you understood that we got all those ones there. So that is our normal capital allowance that you know. Okay, Mrs. Aguma. Yes, when I get there, I'm going to check it, okay? When I get there, I'm definitely going to check it. Let's take it one step at a time, okay? We are going to check that. If there is need for, if there is issue, then we are going to take necessary correction. Thank you, ma'am. Okay, so at the end of the project has how many years? 4 years. Okay, let me come 5 years. Let me come and show you here what I did so that you understand. If you look at this project, it has year 1, year 2, year 3, year 4, year 5. But what did I do? I charged my capital allowance for just how many years? For just 4 years. I charged my capital allowance for just 4 years. What assumption am I making here? I am assuming that capital allowance will not be charged in the last year of the project. That is the assumption I am making. if you so wish, in as much as the examiner did not give you what you should do regarding capital allowance, you can assume that capital allowance is charged for full year of the project. Alternatively, you can assume that capital allowance will not be charged at the last year of the project. It is your choice if the examiner does not give you direction. However, whichever assumptions you have taken, you need to go and state it, okay? You need to state it after your solution. The 240 is 400 tax residual value for year 2 minus the capital allowance enjoyed in year 3. The capital allowance enjoyed in year 3, sorry, in year 2 is 160. So I will say 400 minus 160. So my tax residual value in year 3 will be 240. Did you get that? So thank you. So let us continue. Now, at the end of the project, sorry, at the year 4 of the project, because I am assuming that capital allowance will not be charged in the final year of this project. Now, the moment I charge the last year allowance, which is in year 4, I need to go and compute my balancing adjustment. Balancing adjustment is the difference between tax residual value and what? And scrap value. Okay. What is our tax residual value? Our tax residual value is the tax residual value in year 4 minus the capital allowance for that year. What is the capital allowance for that year? 0.4 times 240. 96, sorry, 144 times 0.4. 57.6. I will now say minus 144. So that is what is giving that 86.4 as the tax written down value. That is, the tax written down value you are seeing there now is after year 4. That is the tax written down value at the beginning of year 5. Do you understand? That is the tax written down value at the beginning, sorry, at the end of year 5. That is the last year of the project. Now, I will now compare that tax written down value with the scrap value of the equipment at the end of the project, which is year 5, which the question gave me as what? As 40. So you will see that obviously the tax written down value is considerably higher than the what? The scrap value. So that will result in what? Balancing allowance. So it is a balancing allowance, meaning that I am selling the project at a loss. Because normally, if I want to sell this project from the face of the tax law, I am supposed to sell it for 86,400. But I am selling it for what? For 40,000. It means that I'm selling at a loss. Therefore, I will have to get a benefit in the form of allowance. And that allowance is also called balancing allowance. So how much tax am I saving on that allowance? 35% of that, 16,200. So these are what I will post in the solution as my tax saved. So I will go there. I will go to that solution and post my capital tax saved on capital allowance. Can you see that? Tax saved on capital allowance. Having done that, then capital expenditure is 800,000. That's the initial outlay. We are told it will be paid immediately. That's 80,000. Then I need to go and include my scrap value. My scrap value will occur at the end of the project. The project was all end in 2014. Please don't get it wrong. The project ends when? In 2013. So I'm going to treat the scrap value in year 2013. Now, I need to go and sort my working capital. What does the question say about working capital? Let's go and see that. Working capital is expected to be 30 million in the first year of operation, and this will increase by 10% throughout the life of the project. So I will go and increase this 30 million by what? I will increase it. Please give me like just give me 2 minutes. Give me 2 minutes, please. Sorry. Sorry, 2 minutes, please. Let me calculate. Okay, let us continue. Now, it means the first year capital allowance is what? The first year capital allowance is 50 million. And after that first year, that capital allowance, sorry, 30 million is 30 million. And after the first year, the capital allowance will now be increasing by what? 10%. What you are going to do now is to state your year 1, year 2, year 3, year 4, year 5. Okay? State year 1, year 2, year 3, year 4, year 5. When you state it, for the first year, put this 30 million there as capital allowance. Now, from the second year, now start growing it by what? By 10% to get your total capital allowance. After that, you now go and compute your incremental. Let's see. Look at what I'm talking about here. Okay. My total capital allowance, you see that in year 1, I was already given what? 30,000. So from year 2, I will simply grow it. 30,000 times 1.1, that is 33. Times 1.1, that is 36.3. Times 1.1, that is 39.93. Times 1.1, that is 43.923. Can you see that? So these are the capital allowances. Now, I will now have to do incremental working capital. I will have to do what? Incremental working capital. Now, the incremental working capital for year 2 is going to be year 1 working capital, which is what? 30,000. Okay? Year 1 working capital, given in the question as well, 30,000 minus this year 2 capital allowance. Sorry, working capital, which is what? 33,000. So 33,000 minus what? Minus 30,000 will give us 3,000 as increase. Do you understand? It means in year 2, my working capital has increased by 3,000. So in year 3, I do the same thing. I will say this minus this. It has increased by 3,300. In year 4, I do the same thing. This minus this. It has increased by 3,630. I do the same thing in year 5 to get this. Now, which year are they relevant? Capital allowance in year 0, sorry, capital allowance in year 1 will come in year 0. So the one in year 2 will come in year 1. The one in year 3 will come in year 2. The one in year 4 will come in year 3. And the one in year 5 will come in year 4. That is how we sort our capital allowance. So I will go there and put my capital allowance in the solution. Sorry, working capital, I meant to say working capital in the solution. You can see this is year 1. I treated it in year 0. This is year 1, year 2 for year 1, year 3 for year 2, year 4 for year 3, year 5 for year 4. Now, after that, I will now have to add all the capital allowances up till this point. I will now recoup it when the project ends. I will recoup it when the project ends. Okay? I recoup it when the project ends. So this is how to sort the capital allowance. Once again, let me ask whether we will have issue as to the sorting of the capital allowance. before we continue? Any question on that before we continue? Any question? Do we have question on this? Okay, so ask your question. If you're Mark, ask your question, please. Ask your question, please. I don't want us to waste time. Ask your question on time so that we can move ahead. Yes, you have to do incremental working capital. Okay, you have to do incremental working capital. You have to do incremental working capital. Except the only situation where you will not do incremental is where your working capital has been computed on the basis of incremental revenue. If you have done incremental revenue and you computed your cost of your working capital based on incremental revenue, then in that case, you don't need to compute incremental working capital again. But if they just give you your capital, working capital, just as we have it here, please, you have to do incremental working capital, okay? You have to do incremental working capital. So that's that. Let us continue. Now, when you sum all this, we have our net cash flow. This is our net cash flow. This is our net cash flow. Okay, let us confirm it to be sure that there is no issue in the cash flow. This is 830,000. There's no problem with that. 126,000 minus 3,000. That is 123. That's correct. Then 170 minus 44.1 plus 140 plus, okay, minus 3.3. That is 262, 600. That's correct. Then 440 plus or minus 59.5 plus 56 minus 3.63. That's correct. 432.87 is correct. Then I have 260 minus 154 plus 33.6 minus 3.993. That is 135.607. That's correct. 480 minus 91 minus 91 plus 20.1 plus 40 plus 43.923. That is 493023. So all figures seems to be correct. All the figures seems to be correct. Now, we want to discount. Don't forget, yesterday, I said, for you to get base case NPV, you need base case net cash flow. Now we have gotten our base case net cash flow. You now ask yourself question, when you are doing APV, what cost of capital do you need? I want response from you, please, so that we'll be sure that you remember what we treated yesterday. To discount base case net cash flow, which cost of capital do we need? Cost of equity. What type of cost of equity? We have two types of cost of equity. I told you yesterday. So, which of the two costs of equity do I need? Hey, you people are missing it. Okay, K, you said better of asset. I did not tell you that you should discount base case net cash flow with better of asset. Okay, Ahmed Munir, thank you. Maybe Aguma, thank you. So, Aisha, and so on and so forth. Thank you all. For those of you that are saying better of asset, please, I wasn't the one that taught you that. Okay? I only told you that you use better of asset to compute what? To compute cost of equity on GED. If you look at the note I gave you yesterday, the brief note I gave you yesterday, you will see that that's what I said. I did not say go and discount base case cash flow using better of asset. No. That did not come out from my mouth. Please, take note. So we need cost of equity of an ungeared company. And because this project, we are diversifying, we are giving Banga as our what? As our proxy company. So I will go to Banga, I pick the better of Banga. Better of Banga is a J better. So I need to ungear it because Banga is having debt, equity in its capital structure. So I'm going to ungear it using the debt equity proportion of Banga. So, and the debt equity proportion is 30%. So I go there straight. I go to the computation of unlevered ungeared cost of equity. Our proxy company, Banga, PSC, proxy better, 2.4. Can you see that? Now, because it is equity better, I need to ungear. So I'm ungearing it. Ungearing it means that I want to eliminate the financial risk in it. Because this better is having two types of risk: asset, business risk and financial risk. What I'm interested in is business risk. So I need to remove financial risk. And the process of removing financial risk is what we call the what? Is what we call the ungearing process. Okay. So to ungear, we need this formula. Please, don't start struggling to cram formula. You don't need to cram any formula. Okay? Don't go and be cramming formula. This formula will be given to you in the exam. The formula will be given to you in the exam. You just learn how to apply the formula, okay? Okay. Now, what the question gave to us is debt over equity plus debt. Please pick your pen. Pick your pen and put this thing down. Pick your pen and put this down. Because from experience, the debt equity stuff is one major area of confusion to students. So let us solve that. I don't want to stop sharing this. That's why I said pick your pen so that I can explain. I don't want to stop sharing my document and share Excel file. So pick your pen so that I can explain to you. Okay? Now, we have two ways of computing gearing. We have two ways of what? Computing gearing. One, right? One is debt over equity. I believe you are writing. Debt over equity is the first one. The second one is debt over equity plus debt. Or the question may state it as debt over debt plus equity is still the same thing. Now, if in the question, your journey is given to you in terms of debt over equity, you go to the first formula because the question has told you that the journey in that question has been computed using what? Debt over equity. So what will you do? You simply go to that formula, debt over equity, where you see debt, put 40 all over the denominator. You know, debt is the numerator, right? Debt is the numerator, while equity is the denominator. Now, the numerator is debt, put debt there. the amount of debt given to you, put it there. Why the denominator is equity? The denominator at all time must always be 100%, okay? It must always be 100%. So if what you have there is only equity, equity alone will take the whole 100 because equity is in denominator. And I told you that the denominator must always what? Must always be 100. So if it is only equity that is the denominator, put 100 there. It means equity is 100. Do you understand? But if the question gives you your journey as debt over debt plus equity, then what does that mean? Where you have debt, go and put debt there. That is, I'm using the second formula now. Now, come back to the denominator. In the denominator now, I'm not only having equity, I'm having debt and equity, isn't it? So what will I do? Where I have debt, I will put the amount the question give me as debt, I put it there. Now, it means equity is the balance. I will now say my equity is 100 minus debt because the sum of equity and debt must give me 100. Do you understand? The sum of equity and debt must give me 100. So it means in the second one, I'm going to have debt over equity plus debt. Debt over equity plus debt. The debt plus equity there is 100. While in the first one, only equity is 100. I believe that is clear enough. And I believe you have written it. Okay. Now, from the journey of, what's the name of the man? Banga. Value of debt is given as 30. If you look at it, is debt over debt plus equity, Abi? That's what is given to us as the journey of Banga. So debt over equity plus debt. So in the debt, I will put 30 because that is what the question gave to me. In the denominator also, where I have debt in the denominator, I will put 30. Equity will now be 100 minus 30. Equity will be 70. That is why I have my equity as 70 and my debt as what? As 30. Equity as 70 and my debt as what? As 30. So what will I do? This is my beta, 2.4. And that's my beta of equity. My beta of debt, it is not in all cases that the question will give you beta of debt. If the question does not give you beta of debt, you assume that beta of debt is 0. So don't force yourself because you do not see beta of debt. You want to get beta of debt by force. No. If the question does not give you beta of debt, assume beta of debt is what? Is 0 and continue your solution. Okay? And continue your solution. All right. Our tax rate is what? 35%. So I will go to my formula. I want to get asset beta. Asset beta is 2.4 times market value of equity over market value of equity plus market value of debt, 1 minus tax rate. Plus, can you see that? That's the second aspect now. Beta of debt times market value of debt, 1 minus the tax rate over 70, which is what? Market value of equity over plus market value of debt, 1 minus the tax rate. So don't cram that formula. I'm repeating it. Don't cram it. Just know how to apply it and you'll be fine. Now, solving this one further, I get this. This is now mathematics. So I don't need to dwell much on that. When you study, we have a lot to do. When you solve this, we are going to get beta of asset of 2.18. That is our beta of asset. Because I am doing APV, I don't need to regear again. The moment I ungear, what will I do? I go and put that asset beta in the CAPM formula and get my what? And I get my cost of equity ungeared. So I said, cost of equity ungeared is equal to risk-free rate plus beta of asset market return minus risk-free. Okay. Now, I need to get my risk-free rate. I need to get my risk-free rate. Let me go to the question so that you understand what I'm going to do there. I want to do some wayo there. I want to do some wayo there. So look at what I'm going to do, because all those, the way you are seeing neighbor, you are seeing basis point, you are seeing that, then it means there are some manipulations that the question wants you to do. And what is that? Look at it. Where do I have that information? Okay. The company cost of debt finance is NIBOR plus 180 basis points. NIBOR is currently 5.4%, which is 40 basis points above the 1 month Treasury bill rate. Don't forget that the Treasury bill rate is what is assumed to be what? Risk-free. Or have you forgotten? Please don't forget. Please don't forget. Your Treasury bill rate is regarded as risk-free. $168 over 89 is what? 2.03. What do I? Okay, let me confirm what you are saying. $168. I'm coming. How many, please? 168 divided by 89.5. That is a. Oh. 168 divided by 89.5 is 1.88. Okay. And how about the other one? 13.65 divided by 89.5 plus 1.88. Okay. Okay. Sorry about that. So we should have, this one should go, please. Cancel this. Cancel this. Okay. So what we should have, our final answer should be 2.03. Our final answer should be 2.03. Okay. Our final answer should be 2.03. Okay, let's see what that will be on our what? Let's see what that will be on our cost of equity on GED. Okay. So what would that be? 2.03 times 3.5, then plus 5. 12.1%. So approximately 12%. Okay, not 12.63. It should be 12%, approximately 12%. Thank you for that observation. That is a very nice observation. Valentina Uzo, you are correct. So it is everything that is 2.03. Okay, everything is what is giving us 2.03. Thank you. So yes, 12%. So thank you. Let us continue. So we are going to adjust it when we discount. So let us now go straight. You know, the moment we finish on this, because we are doing APV, we did not what? We did not regear. That is it. When you are doing APV, you do not regear. The moment you finish on gearing, just put it in CAPM and get your cost of equity on GED. Why did you compute BD? We were not given BD. I thought it would be 0. You always ignore my question. Charity, charity, charity. It is, honestly, it is annoying when you say I ignore your question. I don't know you physically. I have never met you before. Why should you say I ignore your question? If I don't take your question right from the beginning of this class, the rule is that some question might be taken during the course of the lecture or at the end of the lecture. That is what is stated in that rule, and I believe all of us know that rules. So when you accuse me that I ignore your question, I don't think that is the right word to use here. Okay? It's not appealing at all. It's not appealing, honestly. Okay? I don't know you. I don't have anything against anybody here. Your success is my concern on this platform. So why should I ignore your question? Upon what basis that I ignore your question? Which question did you ask that I have not gotten response? At every point in time on this platform, I will stop and say any question, and I will give you some minute to ask a question, except I've gone before you ask that question. Is then I will now, maybe I did not go back to read, but definitely after the class, I'm still going to respond to those questions. Okay, please, let us try to exercise some level of patience, please. Okay, your success on this platform is my concern. If I'm here teaching and at the end of the day, you don't get anything, have I benefited anything? I've not benefited anything. You understand? If you pass, I pass. If you fail, it is my own personal failure. Do you understand? So I do not, let me put it that way, I do not ignore your question. Now, you can see that if I ignore your question, I will not even read this one. You understand? So the moment I see debt, better of debt, then I say, let me go and look at it. And then the one we are talking about here, if you look at the question, you see that we are given better of debt, okay? It is only when the question did not give you better of debt that we assume it is 0. Do you understand? If the question give you better of debt, we are not assuming it to be 0. Let me show you the better of debt given to us in this question, okay? I did not compute the better of debt. No question will tell you to go and compute better of debt. No. It's either the question give you better of debt or the question does not give you. Look at it. What I underline here. Assume that debt better for both companies is what? Is 0.7. Can see it. Assume that debt better for both companies is 0.7. It's 0.7. So I did not compute it, rather it was given in the question. It is when it is not given in the question that you assume it is 0. I believe that is clear. What's the name? Charity. Charity, did you get it now? Hello? No. There's no, I'm just trying to correct an impression that I don't ignore it. You understand? I'm just trying to correct an impression that I don't have any issue with anybody on this platform. I can never have any issue against my students. Okay? So that is, I believe it is clear now. Okay, good. Now let me see your former question so that I can respond to it now. So that at least I will use that one to clear the hair. Let me see the question you asked previously that maybe because of an oversight or because I've passed through that place, I did not respond, so that I can quickly respond to it. Charity, please, let me have your question. Your formal question. Which up? Can you just, because I have many charts here, you understand? I have many charts here. If you can just send it, it will be better. It was, okay, what happened to the capital allowance? Just say it now so that you are clear for once and for all. What happened to the capital allowance? Let me go there so that I see. Capital allowance. Okay, these are capital allowance. Okay, what's the issue on it? Yes, Charity. Okay, let us continue. Let us continue then. Okay, your question has come in. Let me see. I'm confused on how you got it. Okay, now let me quickly explain that then. Let me quickly run through it. Okay, you're okay now. All right, thank you. Thank you. Sorry about the oversight. Very sorry about that. It's not that I ignore your question. It was just an oversight. Okay, thank you. Now, we have gotten our 12%. Please discard this 12.63. We have gotten 12% now, Abi. 12%, because the beta we are supposed to use is supposed to be 2.03. Now, that is what you need to discount the base case net cash flow. This is the base case net cash flow. Okay, this is the base case net cash flow. Discount factor at 12%. Well, let us quickly change that. 12%, year one, that is a 12, that is a 1.12 raised to power minus 1. Please, you can put it down in your notes. That is 0.893, is 0.893, is 0.893. I mean, do it again, 1.12 raised to power minus 1. Yes, okay. So if I now say raised to power, please help me to put it down. Raised to power minus 2, that is 0.797. Raised to power minus 3, that is 0.712. Are you putting it down? Raised to power 4 is 0.636, and raised to power 5, raised to power 5 is 0.567, and the last one, raised to power 6, will now be what? Is 0.507. Okay, so please, you know this PDF, I will not be able to insert it here. Insert it and do the computation. Okay, insert the new discount factor, do the computation, and let me see what your final figure will be right here as a present value, and give me the net, the base case NPV. I believe you got what I said, Abby? Okay. So what is it? What will be our base case NPV after making those corrections? Mrs. Akuma, thanks for the, I thought you were the one that chatted me, right, on that. Yeah, I think so. Even though I was not able to respond then, but I remember you chatted me. Thank you about that. So what is the base case NPV, please? So I can quickly go to PV of finance effect cash flow. Are we doing it at all? Are we asleep? Are we tired? Just endure. In the next 3 weeks, the exam will have commenced and nearly coming to an end. 71, yeah, thank you, ma. Thank you, ma. 71,194. 71,194 as against what? As against 32, Abby. As against 32. Okay, thank you, ma. Thank you. Is it as against 32? Or is it everything that is 32? Let me see. Yeah, it's as against 32. Okay. Now, let us go and solve 71,194, please. Take notes. 71,194. That's our base case NPV. Now, we now have to go and sort PV of finance effect cash flow. Okay. Let's go and sort the finance effect cash flow first. Now, don't forget, I've given you the template that we need to follow yesterday, Abby. I believe you have that template right there with you. Now, on that template, What did I say is going to be the first thing you have to do? What did I say is going to be the first thing you have to do? I said the first thing to do is that you need to what? Compute the total finance requirement. Abi? That is this project. What is going to be the total finance that the project will require? Now, let me go back to that, our NPV table. Let me go back to that table. Now, look at it. If we want to undertake this project in year 0, we are going to need capital, an amount for capital expenditure of 800,000. In that same year 0, we are going to have an amount for what? For working capital. So it is the sum of the outlay and the initial working capital, the first year working capital. Because you are doing that project for the first time, okay? So the working capital, sorry. Okay, we are doing it for the first time. The first year working capital is going to be part of the finance you need. Do you understand? It's part of the is part of your finance requirement. And look at it. The question says that the question says we are going to finance that project entirely by debt. I believe you can see from there. That's why I told you, I said it is not all I gave you in that template that we apply per every question you are solving. You understand? It depends on the information provided. In this question now, the question let me know that the project will be financed entirely by debt. So it means that I'm not going to have equity. And the debt, the question did not tell me that it's going to be subsidized loan. So I'm going to assume it is normal loan. Since the question did not tell me, it is what? It is a subsidized loan. I will assume it is a normal loan. Okay, having sorted that, I come to the next stage in the format I gave you. Issue cost, right? Issue cost. We're told that issue cost is 2% of the finance. You will see that I gave you two formulas there. If issue cost is on gross finance, and other one, if they just give you percentage of issue cost. In this question, they just gave us the percentage of issue cost. We are not told this on gross finance required. So in that case, I will use the second formula, which says just multiply the percentage issue cost by what? By the amount of issue cost. And that is what gave me what? 16,000 naira. Can you see that? This is how to sort it. It is not more than this. That's why I say APV is not substantially different from NPV. This is the only thing that is what? Making it a bit more difficult than NPV. Now, when am I going to issue this debt? I will issue that debt immediately, isn't it? I will issue it in year 0. Therefore, my issue cost is going to occur that same year. The same year I'm issuing the what? I'm issuing the fund. I'm issuing the debt. So it's going to be year 0 cash flow. You must be able to determine all this. Know the year that the cash flow will arise. The cash flow here will arise when in year 0. So it's a year 0 cash flow. Okay, after that, I will have my tax saved on issue cost. Tax saved on issue cost. Now, the question did not tell me that we have that issue cost is tax allowable. Let me check. Let me double sure that the question did not tell me that. Okay, you see that the question did not tell me that issue cost is tax allowable. Now, if I were to be in the exam hall, I will assume that issue cost is not tax allowable. The moment the question did not give me that issue cost is tax allowable or not, I will assume that it is not tax allowable, so that I will ignore step 2. Do you understand? But because I am teaching, that is why I assume it is tax allowable. If I were to be writing this exam, my assumption is that issue cost is not tax allowable. So I will leave that step 2. But because I want you to get how to sort the issue cost, the tax saved on issue cost, that is why I'm assuming it is tax allowable. Okay, the 0.02 is given in the question as 2%. 2%, look at it. Issue cost is 2%, is given in the question. 2% is 0.02. Okay. Now, after you have sorted issue cost and tax saved on issue cost, the tax saved on issue cost is simply the amount of issue cost computed in what? In step 2 multiplied by the tax rate. That is the issue cost. And the issue cost, the tax saved on it, you know, tax is paid a year in arrears, right? So it's going to occur in year 1. Tax is paid a year in arrears. Issue cost is year 0 cash flow. The tax on it will now occur in year 1 because tax is paid a year in arrears. Okay. After we have done that, we go to tax saved on interest. Tax saved on interest. On this particular question, we have only one interest because there is no subsidized loan. We only have one source of a loan, which is what? Tax saved, which is normal loan. So I now say tax saved on interest. What is the amount of interest? 830,000 plus 16,000. Don't forget, the 16,000 here is part of what I'm going to borrow. Okay? It's part of what I'm going to borrow. You will take 830,000, which is what? The capital expenditure plus working capital. But what about the issue cost? You are also borrowing the issue cost. That's the assumption. So you add the issue cost to the amount you are using to fund the project. Then what is our cost of debt? We're told that our cost of debt is what? Is NIBOR. And NIBOR is 5.4%. Okay? Our cost of debt is NIBOR plus 180 basis points. And NIBOR is what? 5.4%. So I'm going to have 5.4% plus 1.8. And that is what gave me 7.2%. That is what gave me 7.2%. Yes, issue cost is 16,600, yes. I think that's what we did, Abby. Or did you do anything contrary? Oh. Okay, I got it. That's a interpolation error, 16,600. So I have 16,600. Kindly correct it there, please. That's typographical error. It's not 16,600 plus what? Plus 830,000. Yes. So the total should be 846,600. 846,600. You now multiply by what? Is 0.072 to get what? 69.55. Now we now multiply by the tax rate, which is 0.35. I get 21,334. 21,334. Okay, though it's not significantly different. It's not significantly different, but you can correct it. 21,334. Now, that is our tax saved. Yes, of course. If you're more careful, you can assume it is tax allowable and state your assumption. The reason why I prefer you assuming it is not tax allowable is because I want you to reduce your workload so that you can save at least 1 minute. You understand? You know, if you save 1 minute, that 1 minute can give you another 1 mark somewhere else. So that if you want to score 49 before, that 1 mark will push you up to scoring what? 50. That is why I will say, assume it is not tax allowable. It is just for you, okay? It is just for you to save time, okay? For you to save time. Okay. If the 16 is not added, will the examiner mark the answer wrong? Not really, not really. Examiner will not mark it wrong because you see, APV has some shortcomings. In fact, if you look at some textbook, you will see that the issue cost will not be added. And if you look at some textbook, the issue cost will be added. Do you understand? So whichever approach you have taken, you should be good to go. But I prefer, because practically speaking, issue cost is part of what you are borrowing. So that is why I prefer it should be added. But if you do not add it, there is no penalty. And of course, you can just go and state it there that you don't assume that issue cost is part of the amount raised. Okay, you are assuming that issue cost is paid from your what? From your pocket. You understand now? So whether you add it or not, you should be fine. Okay. The finance required is the total of capital expenditure and working capital in year 0. Yes. Yes. Yes, that is the working capital in year 0 plus the what? Initial outlay in that year 0 is the total finance required. And that is on which we are going to compute your issue cost. I believe that is clear. Any other question before we proceed, please? Any other question before we proceed? Excuse me. If that was saved, okay, if that was same year, as probably we start save on issue cost be, yes, ma'am. You state it in year 0. However, you even see some question they treat it in year 1. Okay. See, APV is highly subjective, you understand, especially in the PV of finance effect cash flow, you understand. Now, normally, because the issue cost is year 0 cash flow, if tax is paid in the same year, my assumption should be that the tax will also occur when? In year 0, you understand. So that is why I treat it in year 0. But you see some question, even though the issue cost is year 0 cash flow, they still go ahead and put the tax saved in year 1. But whichever one you do, then no examiner will not mark you wrong. Okay, practically speaking, examiner will not mark you wrong. But to be on the safer side, please treat the tax the normal year is supposed to be treated. You understand? The same year is supposed to be treated, please. Okay. Any other question, please? Any other question? Okay, I think we are fine, Abby. You will see that sorting the finance effect cash flow is not a big issue. Can you see that? It's not a big issue. As a matter of fact, I am going to leave you with the question on okay, my host, no problem. No problem. Your issue is noted. No problem. Okay, so I said you notice that sorting the finance effect cash flow is not a big issue at all. So the second question, because of our time and because of the topic we still need to cover, I am going to leave you to that question to go and what? Look at the way I solve it and understand it. However, on Thursday before we do anything, I will use 20 minutes to take question from that topic and from that question. Okay, from that question, I will take question from me so that if there's any area you do not understand while going through it, you you will ask so that I can make clarification. You understand? And apart from that, you see that I put exercise question after that Fubuki code. That's after question number 2. So also practice the same question. I'm going to solve that and post the solution to the platform. I'm going to solve it and post the question, the solution during the weekend. Okay, I post it during the weekend. Okay, so thank you. So let us continue. So our tax saved on interest now is going to be what? It's going to be from year 2 to 6 because tax is paid a year in arrear. Because tax is paid in a year in arrear. Our tax saved is going to occur from year 2. That is, the tax you are saving in year 1 is going to what? Be applicable in year 2. Okay, for 5 years. That's why we have year 2 to what? To year 6. Okay, that's why we have year 2 to year 6. Okay, now I don't have subsidy. I don't have to do excuse me, I don't have to do tax saved on net savings on subsidized loan. Can you see that? It is the information presented in the question that will give you direction as to the items you need to sort in your finance effect cash flow. So these are the cash flows that is applicable to this particular question. Now, adjusted cash flow. Sorry, adjusted present value. Don't mind me. Adjusted present value. Now, okay, the figure we got earlier is what? 31,194, right? Or 71. 71,194, right? Mrs. Akuma. Am I correct? The one we corrected. Was it 71,194? Okay, thank you. 71,194. So that our base case NPV now, you correct it to 71,194. Now, our finance effect cash flow, we need to discount it, isn't it? We need to discount it. Now, you now ask yourself, what cost of capital, what discount rate do you need to discount that finance effect cash flow? Now, you can use either of two rates from what I discussed with you yesterday. You can use the risk-free rate, you can use after-tax cost of debt. You can use the risk-free rate, you can use after-tax cost of debt. It depends on your own assumption. That is the greatest weakness in adjusted present value. The discount rate used to discount the base case the finance effect cash flow is highly subjective, as the student can use either the risk-free rate or after-tax cost of debt, and obviously the two of them cannot give the same result. Do you understand? If I am to solve a question on APV and you are to solve the same question on APV, we might not get the same result because the discount rate you will use might be different from the discount rate I will use. And if you look at it, the way you treat your issue cost might be different from the way I will treat my issue cost. So we might not necessarily get the same result, but both of us will still be what? Both of us will still be correct. I believe that is clear. Okay, as far as I am concerned, I prefer using the risk-free rate, okay? I prefer using the risk-free rate of return when I'm discounting finance effect cash flow, okay? So what is our risk-free rate? I think it's 5%, right? 5%. So what will I do? I will say present value of finance effect cash flows, PV of issue cost. Issue cost is 16,600, please. 16,600, because I corrected it here. So it's an error here. So it's 16,600 and discount factor of year 0 because issue cost is a year 0 cash flow. And discount factor of year 0 is 1.00. That's how we got our what? That's how we got our that's how we got our present value of issue cost. And because it is a cost, it is issue cost, it will be in jacket. It is a cost, it will be in jacket. PV of tax saved on issue cost. Now, the PV, the tax saved on issue cost is year 1 cash flow. So I will say 1.05 raised to power minus 1 will give me 0.952. And that is what I need to multiply by what? I will use to multiply the tax saved on issue cost. that is times 5810. That is 553. I'm coming 5810 times 0.952, right? Okay, that's correct. 5531. So because it is savings, so it will be a positive figure. It is an inflow because it is what? It is a savings because it is a saving. Okay, what Charity, which one do you want me to take again? Which one? Is it the issue cost or the tax saved? Yes. Which one? Charity. Okay, tax saved. Okay. Now look at it. We want to solve PV of tax saved on interest. Abi, we have calculated our tax saved on interest before. We have calculated our tax saved on interest before. Up there, I believe you see that. We calculated it as 5,810. And sorry, PV of tax saved on issue cost. We have not gotten to interest. Tax saved on interest on issue cost. We calculated tax saved on issue cost as 5,810. And it's what? It's a year zero cash flow. But because our tax is paid a year in arrears, the tax is going to be saved when? In year one. So what is the present value of that tax saved? I will compute discount factor of year one using risk-free rate, okay? Using risk-free rate. And that is what gave me 0.952. So multiply 0.952 by 5,810. It's giving me 5531. And it's what? It's going to be positive because it's a savings. We are saving it. Whatever you are saving is an inflow. Whatever you are incurring is an outflow. Because I am saving, it is what? It is going to be treated as an inflow. But the other one, because this one is what? Is the cost. I'm incurring the cost. It's going to be an outflow. Do you understand? So PV of tax saved on interest, we have computed our interest to be 21,319. And we agreed that it's going to be year 2 to 6. Abi? So what are you going to do? In order to get our discount factor, you will compute discount factor of year 1 to 6 and deduct discount factor of year 1 in order to get discount factor of year 2 to 6. Do you understand? So I'm going to say 1 minus 1.05 raised to the power of minus 6 divided by 0.05. I will have 5.075. Now, this is discount factor of year 1, Abi, 0.952. I will now say this figure minus 0.952. Then I have 4.124. 4.124. This 4.124 represents discount factor of year 2 to 6. I have eliminated discount factor of year 1. The balance is discount factor of year 2 to 6. And when you multiply by 21,319, that gave us 87,920. Because it is a savings, it is going to be a positive figure. So you now take the net of this plus that is what is giving us 76,851. Okay, now add it to 71,194 that we got here earlier on. So we have 71,194, 71,194 plus 76,851. Our adjusted present value is going to 148,045. 148,045. That is our adjusted present value. So this is base case NPV. This is present value of finance effect cash flow. When you add the two together, your APV will come out. Ladies and gentlemen, this is how to go about solving question on APV. And I have told you the factor that will make you to use APV is when the company want to what? Raise additional fund whether in the form of equity or debt, or a combination of the two, in order to finance the project. And undertaking that additional fund is going to change the journey of the company. If the company will take additional debt or additional equity, but the journey will not be affected, please, you are not using APV. Get it clearly. You are not using what? You are not using APV. You only use APV if the journey of the company is going to be affected. If you what? If the company takes that additional capital to fund that project. Okay? Other secondary factors are what? When you have issue costs, when you have subsidized loan, when there is complicated tax payment, all this one, that complicated tax payment. We have tax on issue costs, tax savings on interest, net interest on subsidized loan. All these are complicated tax payments. So when you have complicated tax payments and so on and so forth, we are talking about APV. But the chief factor that must be there before you do APV, I'm repeating it again, what you must see in the question before you can use APV is when the company will issue additional capital, and by so doing is going to affect the gearing of the company. That is when you are going to use APV. All other factors are secondary. The most important one is the issue of what? Additional finance. I believe we have been able to do justice to the topic. So please go through Fubuki and solve the attached exercise at the end of the session. And when we meet on Thursday, by the grace of God, we are going to have some minutes to take the question. Sorry, to take question on that. I'm not going to solve it again, please. It's not because of anything, but because of our time, okay? Please, because of our time, basically, because of our time. So I'm going to, I want to start business evaluation on Thursday, possibly if I'm able to finish it Thursday and Friday, Monday, Tuesday, if we can do merger and acquisition on Monday and Tuesday, then on Thursday and Friday, I would like to treat option and portfolio theory, so that the last week we are going to devote it to what? We are going to devote it to hedging. We are going to devote it to hedging. So let me take your question. Where the additional finance is only equity, do we still treat the same way? No. If it is equity, you can't treat it as debt now. You give it the treatment of equity. It means there is not going to be interest, because you don't pay. You only have what you are going to have. If you are financing the project by only equity, what you are going to have is you can have issue cost. That is if the question asks you that there is going to be issue cost. Otherwise, if the question is silent, you assume there is no issue cost. So the only thing you will have is that you can have is issue cost and tax saved on issue cost, because you cannot pay interest on equity. So there's not going to be tax saved on interest. Are we together? And of course, if the question says, the question is telling you that this project will be financed by equity, and the question stop there. The question did not tell you that this equity will incur issue costs of this also amount, and it's going to be tax allowable. The question did not tell you that. Then it means there is nothing to sort in finance effect cash flow, because you cannot say you are computing interest on equity. Do you understand? Excuse me. You cannot compute interest on equity. So if it is equity, treat it as equity. If it is debt, treat it as debt. Ifeoma, I think that is clear, right? Okay, thank you. Any other question? Any other question? So I think I've given you what I intend to cover with you people, Abi. After APV, business valuation, after business valuation, merger and acquisition, After merger and acquisition, we go to portfolio theory. After portfolio theory, we go to, what do you call it? Option pricing theory. Then we cap it up with what? With hedging. Oh, Charity. Charity, there's no offense coming. I'm just trying to correct that that it's not that I'm ignoring your question. You understand? You can chat me up after the class, okay? Chat me up on WhatsApp after the class. So there's no offense committed, nothing at all, okay? There's nothing at all. Thank you. Any other question, please? Okay, you're welcome, everyone. So in the absence of any question, let me release you so that we can relax in preparation for tomorrow's work. Before then, do have a blissful night rest. I'll see you on Thursday, 7 to 9, by the special grace of God. Bye.